All right, friends, entrepreneurs, fellow business owners, and appraisers, if you've been following the BOI or BOIR situation from last year, that stands for Beneficial Ownership Information Report, and whether or not you are supposed to file, I've got an update for you. Before I do that, let me caveat all of this with this is not financial advice, nor is it legal advice. I am not an attorney. I am not a CPA. I'm simply giving you an update as of January 15th. Yes, 2025, and where the beneficial ownership information report filing requirements stand. If you already filed your BOI report sometime last year, or I think they had a deadline of maybe January 13th or something, nothing to be done. You've already done it, nothing to worry about. This is just an update for the people who either have not filed or have been waiting to see what has been going on with it. Those of you who want more information on this, it is a federal requirement. It was a federal requirement. This is a creation of the federal government, their FinCEN division, which is kind of a financial crimes investigation, transparency around fraud and transparency and illicit money transactions. They're basically, if you have, I believe it's 25%. Don't quote me on that. 25% or more ownership interest in a business, you are, or some type of entity, you're supposed to file this BOI report, Beneficial Ownership Interest Report. So if they have the names of everybody who has any kind of interest in an entity or in a business. You can look at the dates too of if you had filed some kind of corporation. Prior to January 1st of 2025, you had so many days to do it. If you file after January 1st, 2025, you had so many days, 30, 60, 90 days, something like that. Make sure you check the website. Either way, at some point, I believe sometime in December, the Fifth Circuit Court filed an injunction against the BOI, the FinCEN, and said, this is unconstitutional. You cannot make people file this report, and they put it all on hold. And then there was a little bit of a kind of a ping pong back and forth where it was taken off hold, and no, it is legal, no, it's not legal. Anyway, where it sits right now is there still is an active injunction. In fact, since that time, 25 more states, my state is not one of them, filed also injunctions stating this is unconstitutional. This should not be in the hands of the federal government. Let's push it to the states. Where it sits right now is they have slated for oral arguments sometime in March. Federal government does not like to wait on these kinds of things, so they basically are trying to push this up to the Supreme Court to say, hey, decide on this now or overturn the whole thing. Now, the federal government, the Supreme Court does not have to take the case. They could push it down to the lower courts and tell them, you guys deal with this. We got bigger fish to fry. But either way, if it does make its way to the Supreme Court or they decide to take on the case, they essentially have to appeal or get the approval of, they must convince one justice, Samuel Alito. For those of you who have been waiting to see whether or not you should file this BOI report, it's probably good news for you if you don't want to have to file it, because Samuel Alito tends to be a constitutionalist. He tends to be the one who says smaller government, take things out of the hands of the federal government, push it down to the state, so on and so forth. I'm not making an opinion on whether or not that's good, bad, right, or wrong, just telling you where it is. So as of today, January 15th, 2025, do whatever you want to do. I don't really care. But if you haven't filed it yet, of course, check with your attorney, check with your CPA. We checked with our CPAs back in November, December, and they told us, check with your attorney. So even then, when it was not a controversy, they said, we're just CPAs. They pushed it off to attorneys. We checked with our attorneys in December. The attorneys basically said, here's where it is. It's going back and forth. And so we're on hold for now. So we chose to hold, but my recommendation to you is check with an attorney and or your CPA on whether or not you need to file. But as of today, it's on hold. My guess is that if it comes off of hold and the federal government wins in this case, that you do have to file it. Don't take this as a quote or as a fact. My guess, though, is that there will be a little bit of some amnesty since it's been back and forth. And they will say, okay, yes, you do have to file, and no penalties as long as you file by whatever date. So as of January 15, 2025, that's where it sits, the Fifth Circuit. The injunction is still in place. 25 states agreeing with the injunction, saying this is unconstitutional and you do not have to file. And we are waiting to see what happens there. All right. let's move on to Fannie Mae's housing predictions for 2025. Sorry, let's get this back to the top. And here we are, 5 housing market predictions for 2025. We expect many trends from 24 to continue in 2025. Brief summary, 2025 is going to be a lot like 2024. And here's why. How the housing affordability and the mortgage rate lock-in effect, as you can see right here, we've been hearing about the lock-in effect for, well, a couple of years now as rates have gone up. What is the lock-in effect? Just as it sounds. A lot of people, and you're going to see 53 or 58% of people have a mortgage interest rate below 6%. In fact, a lot of people have mortgage interest rates below 4%. The lock-in effect is if you've got an interest rate in the 2s, 3s, 4s, maybe even the 5s, why would you refinance or sell out of that if you did not have to? Now, on a particular note, especially for lenders and or real estate appraisers especially, since I coach that business, I own several of those businesses. If you have not started to focus on building your non-lender appraisal business, what are you waiting for? Start now. As business changes, evolves, shifts, as forms change in the appraisal world, and as appraisal waiver thresholds increase first quarter of this year from 80% loan to value to 90% loan to value, we're going to see the cookie cutter assignments, the easy assignments, we're probably going to see those start to decline even more this year. And so if you don't have strong relationships with a lot of local lenders, which I know a lot of appraisers don't, you're heavily weighted on the AMC side of things, you've seen your business take a hit, and likely that is not coming back, barring some black swan event and some major market change or supply and demand change that might change that. However, my recommendation is you start now, today, building up the non-lender side. The non-lender side of your appraisal business, which divorce appraisals, estate appraisals, pre-listing appraisals. There's a whole big long list. We talk about it in my coaching program all the time. If you have not started, it's not too late. You should have started 5 years ago, but the next best time to start is today. Because there are people who will have to refinance out of their 4% mortgage, and they will take whatever mortgage rate, interest rate there is available today, 6%, 7%, because they have to. People in dire straits, people in unique situations, people with extenuating circumstances. Take, for example, a divorce where one party wants to stay in the residence and they have to refinance and pay off the other party their half or their share of the equity. They will likely have to refinance out of their 3%, 4% mortgage and take whatever is available. It sucks for them. We get it. Divorce hurts. Nevertheless, that is what is going on in the market. We always say in our coaching program, the 3 Ds start to increase when times get tough. That's divorce, death, and default. So estate appraisals, divorce appraisals, foreclosure appraisals, all sad stuff, but they need a valuable partner in the valuation space. So appraisers, listen up, make sure you're focused on that if you haven't. But the lock-in effect is real. In addition to our economic and housing outlook, we also share 5 predictions. The economy poised to end 2024 solid, consumer spending's been resilient, labor market's cooling, unemployment remains low, job growth is currently at a healthy pace. Now here they say, combined with inflation measures remaining stickier, that's essentially their fun word to say we've been wrong the last 5 years about inflation being transient, than markets expected earlier in 2024. The dynamic is occurring with a backdrop of uncertainty over whether solid labor productivity can continue to fuel growth next year, whether inflation will come in for a soft landing, and whether interest rates will remain structurally higher for longer. Okay, you guys can read all about that. And then there are links in here, and I'll post this PDF with my markings on it. These are all my highlights. I'll post those in the show notes. Number 1 prediction from Fannie Mae. Average mortgage rates will decline modestly, means not much at all, but remain above 6% with likely bouts of volatility. Keep in mind, this is not my prediction. This is Fannie Mae's prediction. Things could change. They could all of a sudden drop. Trump could finally, get into office after inauguration, and he could change everything. We don't know. That's the administration tends not to control those things, but anything could change. But this is Fannie Mae's outlook and predictions or forecast for 2025, that average mortgage rates will decline modestly, but they're going to remain above 6% with at times of volatility. You guys can all look at this chart. Those of you who love your scatter plots and your charts and bar graphs and things like that, check out what this all means. I don't really care about it. I care what the interest rates are, and I care what the market is doing. Here they say, given ongoing uncertainty over the resilience of economic growth, the stickiness of inflation, and future policy changes, we expect bouts of volatility in the mortgage rates next year. Yeah, no duh. As we've seen over the past 6 months, the 10-year Treasury yield has oscillated greatly as stronger and weaker economic and inflation data were reported. As we scroll down here, our baseline expectation is for economic growth and employment gains to slow modestly next year, and for core inflation to continue to ease. If you don't know the difference between core inflation and what you might call inflation, what you pay at the gas pump, what you're paying in housing costs, and what you're paying for bread, that's different than core inflation. Core inflation are the core costs. And that's what the arbitrary numbers that the federal government comes up with, their 2% rate that they're targeting, that may have changed 2.5%. But it's an arbitrary number. But that's their number, and they're basically saying core inflation to continue to ease, but not reach the Fed's target until 2026. They're prepping us by saying, expect 2025 to be a stagflation year, essentially. We're going to keep getting inflation, core inflation down, but it's not going to reach our target in 2026. So just sit tight, friends. Okay, moving on. Forecast or prediction number 2. Existing home sales will remain near 30-year lows, but location matters. Well, we know this. This is a no-brainer. Supply, demand. There is demand, although demand has waned some because of the lock-in effect with higher interest rates, but there's still strong demand. There's still people who want to buy houses, primarily first-time home buyers and second home buyers, but the inventory is not there. So essentially their prediction is we don't see much change there. The existing home sales are going to remain near 30-year lows, but location matters. Well, location has always mattered. It's the first 3 rules you learn in real estate school: location, location, location. We learn that as appraisers as well. You can look at all the numbers here and all the stats. Let's talk about the lock-in effect one more time. Affordability conditions remain at the most constrained level since the mid-1980s. They're saying houses aren't affordable. Again, really? Thanks. Additionally, we expect the lock-in effect to remain prominent even if mortgage rates move closer to 6. At the end of September, 58%. I said it was either 53 or 58. 58% of Fannie Mae single-family loans had a 30-year fixed-rate mortgage under 4%, compared to just 14 with a rate greater than 6%. 58% of all loans at the end of September of last year, loans that were held with Fannie Mae, had an interest rate under 4%. That's the lock-in effect. My interest rate on some of my properties, under 4%. I'm not going to get rid of those properties for an interest rate above 4% or 6%. Doesn't make sense. It's locked in. Okay, you can read all about that, and you can look at the states where things are local. All real estate markets are local. Prediction, forecast, number 3. New home sales will remain a bright spot in the housing market where they can be built. With the continued limited supply of existing home sales, new construction is going to be the thing. So if in your market you can find those builders and those big developments where new home sales are a big thing, that's the thing to be going after. New home sales have averaged an annualized sale pace, units 682,000 in 2024 through October. That was when the stats were being gathered, versus 595, about 100,000 units different 2015 through 2019. And they expect that similar trend in 2025. Now here they say something we all know if you've been in the builder market. In the face of elevated mortgage rates, home builders continue to show a willingness to offer incentives like interest rate buy-downs to move their inventories of new homes available for sale and to change the products offered to be smaller, more affordable homes. If you are like me, where we appraise new construction, new developments, things like that, you will also see that some of the incentives that builders offer are incentives not just rate buy-downs, but they'll give big package incentives to upgrade your countertops and your cabinets and things like that, and they'll say for free. The sale price is $500,000. We'll give you $40,000 back in incentives. You can upgrade your packages and things like that. So kind of screws with how you choose comparable sales and all that, and true market value when you use the Fannie Mae definition of market value. But that's what builders are doing right now. Okay. Number 4, prediction from Fannie Mae. National home price growth will decelerate. Home price growth is going to slow down. While the continued lack of inventory for homes available for sale has helped to keep home price growth robust, we expect a continued deceleration in home price growth into 2025. By the way, appraisers who are watching this, share this information with your local markets. I talk all the time about how you should be the local authority in your market for this kind of data. Take what I'm doing here, take this sheet, take my marked up sheet if you want, the PDF, and share it with all your local realtors so that they understand you understand what the market is doing, and share with them what Fannie Mae says some of the stats are going to be, some of the predictions and forecast is going to be. National home price growth is going to decelerate. Now, they play a little bit of a numbers game, shell game here. We currently project year-over-year home price growth will be 3.6% in 2025. Now, keep in mind, all markets are local. Yours could be different. They're saying projected overall. Big market, big M market. As measured by Fannie Mae Home Price Index, compared to 5.8% in 2024. Home Price Index. And they're talking about growth. They're saying in 2024, home price growth overall, that's not to say we have areas in our greater market, we have sub-markets, smaller markets, where home price growth was 7%, some was 10%. But they're saying overall, United States, home price growth in 2024 was 5.8%. They're saying it's going to slow year over year to 3.6% in 2025. You're not going to see those big swings and big increases overall. Your market might be different. While mortgage rates will continue to present, this is the purple here, an affordability challenge, softening the home price appreciation in 25 could allow for nominal wage growth to exceed home price growth for the first time since 2011. Don't get excited. Here's what they're saying. Softening home price appreciation, that's that 3.6% number here, could allow for nominal wage growth to exceed home price growth for the first time since 2011. They're essentially, it's not going to say, they're not saying all of a sudden, oh, wages are going to go up a whole bunch and they're going to catch up with home prices and all of a sudden a lot more people are going to be able to afford houses. No, that's not what they're saying. That's why I say they're playing a little bit of a shell game. They're saying that the home price growth number, the percentage, may for the first time since 2011 be less than the nominal wage growth. So if the home price growth is 3.6% in 2025, the wage growth only needs to be 3.7% to exceed the home price growth index. Okay, so your wage, if you work for a corporation, they only have to increase your wage by 3.7% to increase the home price growth index. Hopefully everybody gets what they're saying here. Okay, they do say here there will likely be considerable regional differences. That's their backdoor out of all markets are local. Number 5 prediction from Fannie Mae. Multifamily housing will remain in a holding pattern. Funny way to say it's stalled. It's too expensive. I'm an investor. There's many investors who might watch this. Basically, if you just use the 1% rule, if your mortgage is $300,000, you need it to rent for 1% of that or $3,000 to just break even. It's not even a good rule anymore. But that's the basic numbers you use if you're not going to do deeper calculation with all your operating incomes and your expenses and things like that. But multifamily housing is just too expensive for many. And so what they're saying is it's stuck. It's in a holding pattern. We expect 2025 to look a lot like 2024, while longer-term demographic trends remain supportive of the construction of multifamily construction. Where are we here? As the prime renter age population is expected to continue to grow, we expect below average rent growth in the near term as additional units are completed. Rents are not going to keep up with the cost. That's why it's tough. Back in the day, you could find lots of deals, especially if you had cash and you could snatch these things up. You could buy them well below typical market rates and you could rent for more and you could cash flow right off the bat. It's much tougher today with multifamily housing. So keep an eye on those. Those are the 5 predictions from Fannie Mae. Again, look in the comments, not the comments, the notes section of this video, and you can download the PDF. Also the BOI, watch the first part of this video again if you have any interest in learning about the beneficial ownership information reporting and what you need to do about it. Hope this was helpful for you. Check back often. Share this with somebody who you think needs to hear this or might get some value from the information. And I'll look forward to seeing you on the next one. See ya.